everything is getting in the defense. So I'm looking very much forward how we can, in a positive way, bring the debate forward. The floor is yours.
Thank you very much. Thank you for inviting me. It's sort of an ongoing crusade, as it were, to try to get this message across. It's a very hard message to get across to anyone who shows up. I'm personally grateful that you showed up, and I'm grateful that you invited me. How many of you have been to Bath? In England. Yeah, it's a small, as you know, it's a small, sleepy city. It's where the Romans first arrived. As far as I can see, there is not a trace of a financial industry there. There's some bank branches. And yet, when I was in Bath last year, there was Occupy Bath. Now, it was sort of relatively low-key. This is nothing like Occupy Wall Street. I mean, it didn't have the zing. But this is, I think, an indication of several things. This is an indication that there is a global anger against the system, and it is also an unchanneled anger, and it is a diffused anger. So there's one misrepresentation of the crisis that comes from the Occupy Wall Street, Occupy Bath. I don't know if you have Occupy Amsterdam or not. And that is a too broad a notion which says the entire system of capitalism is defective. And so we must get rid of it, root and branch. And this is a view that my friends and my still friends and former colleagues, people like Joe Stiglitz and Jeffrey Sachs, are very happy to encourage. On the other side, there is what I think of as the too narrow view of what is wrong. And this comes from my even larger group of friends in financial economics and in the finance industry. That's where I've spent a great deal of my time. And it's basically, well, the financial system is fine, but it had fallen behind a little bit. I'd argue that there's nothing fundamentally wrong, at least as far as the American system of capitalism is concerned, and I think to a large degree the European system as well, which is that you can always find defects and flaws, but capitalism in the real economy is sound. We have what I call an inclusive game of innovation, and even in these hard times, we must remember it has delivered to all of us a standard of living that our grandparents literally could not have imagined. On the other side, I would argue that the defects of the financial system are not superficial or cannot be solved by minor tweaking. I argue that it is severely flawed. Its flaws undermine the real economy. When I was writing my earlier book, I was my former dean got me into his office, and he said, "Well, this is a really good book. It was on the American innovation system." But he said, "But there's a chapter missing." And I said, "Well, what's the chapter?" He said, "Well, you're not describing why the American system is so innovative." So I said, "Glenn, why is the American system so innovative?" He said, "Because of our financial system." So we need an economic system where productivity improvements are widespread. This means we need both the development of innovations as well as the effective use of innovation. I would argue that it is organized on the basis of decentralized, case-by-case, forward-looking judgment. All of these things are important. Decentralization is important, case-by-case is important, and forward-looking judgment is important. Why is it that the man on the spot, in those days there were no women on the spot, why is it that the man on the spot is better equipped to make decisions rather than, say, a central ministry of agriculture? Why should we let the farmer decide what to plant, when to harvest, who to sell stuff to, rather than a central ministry of agriculture? How is this decentralization coordinated? Hayek's answer was, it is coordinated through prices. Prices cannot be the be-all and end-all of coordination. A crucial part of coordination in the modern world is conversation, is dialogue. When Apple develops a new product, the engineers at Apple have conversations with people who are developing the flash memories to figure out what kind of performance that flash memory will have. When the Apple team works together to make sure that what's going on with the user interface gels with what goes on with the rest of the design, there are conversations. And then all these coordination mechanisms could not exist. The price mechanism would not be effective, dialogue would not be effective, relationships would not be effective unless people had some responsibility for outcomes. If you could lie and you didn't bear any responsibility for outcomes, dialogue would not be an effective mechanism. If you did not bear responsibility for outcomes, the price mechanism wouldn't work. So that, in a nutshell, is my picture of some of the essential features of a good economy. So what does this imply for finance? So I would argue that to the degree that the real economy involves inclusive innovation, that innovation in the real economy is not just in the hands of a few people. Good finance also ought to nurture inclusive innovation. Now, how should good finance be organized? I would argue that good finance ought to mirror the dynamic real economy. That if a dynamic real economy requires decentralized judgment coordinated by dialogue and relationships and is tied to real responsibility, I'd argue that a good financial system ought to have exactly the same character. Let me also say I'm not making an absolutist argument. There are scale effects in the real economy which will limit, just as they limit decentralization in the real economy, they will limit decentralization in the financial economy. You cannot finance a railroad with your neighborhood bank. The capital requirements of a railroad are too large for any one banker to handle it. Actually erode the railroads.
Amar, all those railways went bankrupt.
Not all of them went bankrupt. The bankers who came, the first set of so people like Schiff, the investment bankers who came in after the first bankers who went bankrupt, they did not go bankrupt. That this kind of old-fashioned finance still exists. It exists in venture capital. Venture capital is still done in an incredibly old-fashioned way. They actually have a conversation with the entrepreneur who's asking for funding. But if you look to see where the growth in finance has been over the last 20 years, so it's not like business lending has shrunk, but the big growth, the share, has been in what I call pathological finance. Finance of the sort that I described, highly centralized, involving mechanistic models, does not involve dialogue and relationships, and involves no responsibility for real outcomes. There are two particular manifestations of pathologies. The old securitization involved judgment. The new securitization involved statistics, backward-looking statistics. The other enormous explosion has been in complex derivatives. I was present at the birth. I used to work for McKinsey in the early 1980s, and that was just about the time when the derivatives market was getting started. In 1980, the amount of over-the-counter derivatives outstanding was virtually zero. By the year 2000, it had gone from zero in 20 short years to $100 trillion. Let your mind roll over that number a bit. And by 2006 or 2007, that number had grown to somewhere like $700 trillion. And if you believe at all that there is value to local knowledge in making decisions, this has to lead to a misallocation of capital. The computer cannot figure out, the computer looks at average 5 years of income on the day you apply. The computer cannot tell whether that 5 years income is of a automobile plant worker who, if you read the newspapers, will tell you that plant is closing next week, or the income of a tenured professor whose income, of course, is secure for life. But the model is the same.
I've heard as an explanation for why the banks do not loan as much, that it is that they have to set aside 8 times more regulatory capital
That
than
too.
before.
Yes, that too. So there are a variety of reasons. And regulation, I'll come to regulation, has also tilted very heavily in favor of this mechanistic form of finance. When you have thousands upon thousands of lending officers, their mistakes are not systemic. There is no reason for these mistakes to be correlated. Yes, there are occasionally times when everybody rushes onto the same bandwagon, but at least in the United States, that has not happened hitherto until we got to this mechanistic form of finance. It has also created unmanageable and unexaminable firms. Jamie Dimon is considered the best of the best, but the question is, how much does he know and how much can he know? Today, these things are unexaminable. You walk into you walk into JP Morgan, you walk into Citibank, what do you see? You don't see loan books, you see these enormous computers where whirring behind them is $80 trillion in derivatives, and in the case of who's read these, and who has the time to read this? So then we just sort of throw up our hands, and we hand this problem over to Basel, and Basel will know what the right capital ratio is. And finally, I'd say this is a process that is jeopardizing the legitimacy of capitalism. With this game, there is the correct belief that there is no meaningful wealth creation. What are the causes of this? Since I've gone on for quite a bit of time, I'd argue that it has been enabled. The technology, the guns, the shovels have been provided by Nobel Prize winning work, by models that ignore multifaceted, unquantifiable uncertainties, that ignore differences of opinion, and that ignore the dynamism of the economy. Let us go back not to these top-down Basel type rules, but to case-by-case enforcement of broad rules. I want to go back to on-the-spot examination, not top-down edicts. Of course, if you go in this direction, it's much more labor-intensive. It requires virtually no labor to focus principally on a sound depository and payment system. And oh, by the way, if you do this well, history tells us that you will provide credit within prudent bounds, and you will contain speculative mania. So severely circumscribe depository institutions. That's a depository institution. Severely circumscribe, regulate, and ensure. And the standard should be what a college-educated examiner of average intelligence can understand. As far as hedge funds and investment banks are concerned, don't bother. No further regulation is necessary. I would argue even possible. No further additional oversight. But, and this is a crucial but, no credit or counterparty risk with respect to these regulated institutions.